Hello. In this video, I'm covering section 1.3 on consumer loans. That's going to be the third section of chapter 8. So let's read what is this section about. And we have this quote by Carlyle that debt is a bottomless sea. So from ancient times to the present, sources such as the Bible, Shakespeare, Benjamin Franklin, and others have warned us about the dangers of unbridled credit. In this section, we will explain the mathematics of credit and show how you use it wisely to avoid drowning in Carlyle's bottomless sea. Imagine that you have just signed the lease for your first apartment, and now all you have to do is furnish it. If you buy living room furniture for $1,000, would you pay for in payments? You are taking out an installment loan. Loans having a fixed number of payments are called closed-ended credit agreements or installment loans. Like you get a house loan or a car loan, that's an example of an installment loan. Each payment is called an installment. The size of your payment is determined by the amount of your purchase and also by the interest rate that the seller is charging. The interest charge on a loan is often called a finance charge. So we're going to use the simple interest formula from the previous section to calculate the finance charge for an installment loan. So to determine the payments for an installment loan, we add the simple interest due on the loan to the loan amount, and then divide the sum by the number of monthly payments. So I'm going to copy this box of how to determine the monthly payment of an installment loan. That is a loan with fixed payments. So the monthly payment is going to be the amount of the loan plus the interest over the number of monthly payments. So in example 1, we're going to find the monthly payments. This example 1 on page 409. A new pair of Bose speakers for your home theater system costs $720. If you take out an add-on loan for 2 years at an annual interest rate of 18%, what will be your monthly payments? So what we know, we have that the amount of the loan is $720. The interest rate is P times, is going to be PRT, where the interest rate is 18%, and that's going to be after 2 years. So the interest is what? Is the principal times the interest rate times the number of years. So multiply these three numbers together, and the interest is $259.20. So in 2 years, you have 24 payments. So N is the number of monthly payments. That's 2 years. And each year has 12 months. So that's 24. And finally, the monthly payment this is the amount of the loan plus the interest over the total number of payments. So this is $720 plus $259 with 20 cents over 24 payments. and 720 plus $259.20. This is $979 with 20 cents over 24 months. So finally, this is $40.80. Those are going to be the monthly payments on this loan. Now let's read the next. So in example 1, the annual interest rate of 18% is quite misleading. If you think about it, the purchase price was $720. So it would be fair to say that you're paying $30 of the loan amount each month. And the other $10.80 is interest. When you reach the last month, although you owe only $30 of the purchase, you are still paying $10.80 in interest. So simple arithmetic shows that $10.80 over 30 is 0.36 or 36%. So that's 18% the first year and 18% the second year. So in a certain sense, the interest rate for the last month is actually 36%. Because you are paying 36% interest for 1 month, this is equivalent to an annual interest rate of 432% or 4.32. So what we want to point out here is that although simple interest is easy to compute, as you pay off the loan amount, the actual interest you are paying on the outstanding balance is higher than the stated interest rate. Okay, so we are going to talk about credit cards or open-ended credit. So when you use your credit card to pay for gas at a gas station, you are using open-ended credit. With open-ended credit, the calculation of finance charges can be more complicated than with closed-ended credit. Although you may be making monthly payments on your loan, you may also be increasing the loan by making further purchases. So there are several ways that credit cards companies compute finance charges, and we will look at 2 methods and compare them at the end of the section. You will see that if you understand the method being used to complete your finance charges, you can use this information to reduce the cost of borrowing money. The first method that we will discuss for computing finance charges is called the unpaid balance method. With this method, the interest is based on the previous month's balance. So I will copy the method for computing the finance charge, the unpaid balance method for computing the finance charge on a credit card. Okay, so the finance charge is going to be P. So this is the previous month's balance plus the finance charge plus the purchases made minus the returns minus the payment. And the variable R is the annual interest rate, and T is 112, or the equivalent to 1 month. So the finance charge at the end is PRT. Okay, let's look at example 2. How to use the unpaid balance method for finding finance charges. So assume that the annual interest rate on your credit card is 80%, which is quite common, and your unpaid balance at the beginning of the month was $600. Since then, you purchased ski boots for $130 and sent in a payment of $170. So let's see what we know. So the previous month's balance was 600. Then the finance charge is going to be computed with the simple interest formula. The finance charge for the previous month is what? It's going to be the previous balance at the beginning of last month times 18% interest times 1/12. That is, 1/12 is the equivalent of 1 month. That's that fraction of a year. 1 month is 1/12 of a year. So if you multiply this 600 times 0.18 times 1/12, it's going to be $9. So that's the finance charge in the previous month. What else do we have? We have that the purchases made were $130. The payments, there was a payment for 170. And there were no there were no returns. Okay, so the new month's balance, so this month's balance is P. Let's look back at the formula. That was the previous month's balance plus the finance charge from last month plus the purchases made minus returns minus payments. So that's minus, there were no returns, and a $170 payment. So 600 plus 9 is 609 minus 130 is 479 minus 170, that's going to be $569. And the second question was, actually, I didn't copy the questions, but they were asking us using the unpaid balance method, what is your credit card bill this month? And what is the finance charge this month? Yeah, I should have opened more space. Let's see what I can do. Okay, so I will, yeah, I didn't copy the questions. I'm just going to scroll down a little bit. And this one, I can also move it down. And these were my questions. Okay, that's what we have. Okay, so this answer part A. Using the unpaid balance method, the credit card bill this month is $569. And the finance charge next month is PRT. So that the next month's balance at 18%, multiplied by 1 month, or 1/12 of a year. So to the nearest cent, this is approximately $8.54. Okay, another example of when interest rates can be misleading. That's number 50 on page 417. An online article recommends that you should never borrow more for college than the amount you expect to earn as your yearly salary. The example given is that if you expect to earn $50,000 yearly and have a loan of $50,000, you can pay it off in 10 years by paying 10% or $5,000 of your yearly income. Assuming that your loan interest rate is 6.8%, what is terribly wrong with this example? Not just wrong, but terribly wrong. Okay, so the amount you're borrowing, so you have a loan of 50,000. Supposedly you can pay it off in 10 years. And it says paying 10% of your yearly income. But the loan interest rate is 6.8%. So the interest due it's the $50,000 loan times 6.8% times 10 years. So 50,000 times 68 times 6.8% times 10 is $34,000. So the problem with that is this, or what is terribly wrong with this example, is that 34,000 over 50,000 is 0.68 or 68%. So that's certainly more than the 10% they mentioned. So you would actually pay 68% interest of your yearly income rather than 10%. So you will actually pay 68% interest of your yearly income and not 10%. And not the 10% that they advertised. So yeah, a lot of the advice and a lot of the information can be very misleading. So example 4 shows an example of how credit card companies or banks determine the monthly payment. Okay, so I'm copying the next example. It has 2 parts, or it's in 2 pages, has 3 questions. So there's that part. And I have a question C. So let's read that. So let's revisit the example. So let's revisit the example of the Bose speakers in example 1. Recall that the speakers cost $720, and now you're going to put this purchase on your credit card. Assume that this is the only item that you're charging to the card, that you're charging on the card. The annual rate is 18%, and the minimum monthly payment on the loan is the finance charge out plus 2% of outstanding balance. Assume that each month you are making the minimum payment of your loan. Question number 1, what is your minimum monthly payment? Okay. So it says that the minimum monthly payment is the finance charge out plus 2% of outstanding balance. So the outstanding balance is 720. The interest rate is 18%. And that's going to be after 1 month. Remember, T is the time in years. So 1 month is 1/12 of a year. The finance charge out is 720. Yeah, so this PRT. So this is 720 times 18% times 1/12. And that is equal to $10.80. And the minimum monthly payment is the finance charge out plus 2% of outstanding balance. So that's going to be $10.80 plus 2% of the outstanding balance. So that's 2% of $720. Let's calculate that. This is what? This is 1080 plus 2% of $720. And the minimum monthly payment is $25.20. And here's what's happening. This was 1080. And 2% of $720 is $14.40. So this is interest. And that's exactly the what you pay for your loan. So this is really the loan payment. So out of those $25.20, you're only $14.40 are going towards the loan. So okay, and that answer part B. So you have part B, you have only paid off $14.40. The rest is interest. And finally, part C, it says, this may shock you, but the author used a spreadsheet to calculate that after 24 months of making minimum payments, you will still owe $461.64 of your speakers. What is your minimum monthly payment for next month? And actually, I'll show you how the author is using the spreadsheet. Okay, so the way they compute the loan. Oh, so let's zoom in. Okay, so it's $720. So that was what? That was the finance charge out. The finance charge out was the outstanding balance at 18% multiplied by 112. That fraction of a year. So that was the interest, and the actual amount you're paying for your loan is 2% of the outstanding balance. So in the next line, we're going to subtract that from the previous two. Or we're going to subtract the interest and the actual amount you pay. And next we have, let's compute those two. And the author says that after 24 months, you are still owing something. Okay, so let's go up to 23. And it says, let me see. Yeah, so I'm making sure that, of course, that's a little bit exaggerated, that you don't make any further purchases. Okay, so that's the amount that you have paid. So you started with 720 and subtract that amount. And it says that you owed $391. Okay, let me see. Yeah, looks like I'm missing something. So that's the interest amount. And okay, I see what's happening. Okay, I see what I'm doing. I'm only subtracting whatever goes towards the payment. Okay, so now we're going to have the correct one after 23. Okay, so you're paying that. Yes, okay, so I didn't copy this correctly. And there it is. So after 23 payments, that is by the 24 month, you still owe $461.64. The question was, what is your minimum monthly payment for next month? So in part C, your outstanding balance is $461.64. So the monthly payment or the minimum payment is going to be the the interest, the what you call the finance charge, times 2% of your outstanding balance. And if you calculate that, Let's calculate this. This is $461 with 64 cents times 18% divided by 12 plus 2% of the outstanding balance. And the finance charge is going to be $16.16. And now this would be a little bit exaggerated because that's assuming that they just pay the minimum, but that this person is only paying the minimum, making the minimum payment, and is not making any further purchases. But if that person continued doing that forever, let's say 5 years, 60 months. So this amount would be owed. And the total interest would be, let's calculate that. So this is the interest amount that you would be paying if you're only making minimum payments. Well, minimum payments and you're not making any further purchases. So the advice here is that don't pay the minimum. Always pay your outstanding balance in full. Yeah, you always pay your outstanding balance. So don't carry a credit card debt because that's going to be very expensive. Okay, so that was one method, the unpaid balance method. The other method is the average daily balance method. A more complicated method for determining the finance charge on a credit card is called the average daily balance method. But that's actually what credit card companies use. So with this method, the balance is the average of all daily balances for the previous month. And let me show you, we go to any institution. Let's say we go to Bank of America. And review one of the credit cards. And then let's click on one of those cards. Let's see. Not the secure one. Okay, so one of the standard credit cards. And read the details. It says somewhere that they are using something called the average daily balance method. I probably need to search it. Terms and conditions. Okay, so I'm trying to find that. Yeah, actually, I cannot find it. Yeah, I cannot find it, but just believe me, that's what most of banks use. Oh, there it is. Yeah, how will we calculate your balance? We use a method called average daily balance, included new purchases. So yeah, that's an example from Bank of America. If you go to Wells Fargo or any other popular bank, you'll see that most likely they use the average daily balance method to calculate interest. And let me copy the formula for the average daily balance. That's on page 412. So to compute the average daily balance, or to compute the finance charge on a credit card loan with the average daily balance method, you first add the outstanding balance for your account for each day of the month. Next, divide the total in step one by the number of days in the month to find the average daily balance. And to find the finance charge, use the compound interest, the simple interest formula, where P is the average daily balance, R is the annual interest rate, and T is the number of days in the month divided by 365. So instead of 1/12, you are going to have, or T, instead of 1/12, the fraction of the year is going to be the number of days in the month over 365. Like in May, that would be 31/365. Or in September would be 30/365. So I'm going to show you with an example how this works. Number 30, that's problem 35 on page 417. So there it is. I will copy the directions. And I'll copy the statement of the problem. Okay. So in exercise 35, we're going to use the average daily balance method to compute the finance charge on the credit card account for the previous month. The starting balance and transactions on the account for the month are given. Assume an annual interest rate of 21% in each case. So how do we compute the finance charge? That's going to be PRT, where T is the number of days in the month, in this case 30/365. So I'm going to make a new table with the date, the transaction, the balance after the transaction, and the number of days with that balance. The number of days, multiplied by that balance. Okay, so the month starts on the 1st. There were no transactions on the first day, so the balance was $240. The balance on the 1st was $240, and then from April 1st to April 3rd, there were 3 days. 3 days with $240 balance. That's $480. Actually, that was 2 days. Sorry, that was 2 days. April 1st and April 2nd with a balance of $240. So on April 3rd, this person made a payment, or this person was charged $135 for a coat. So the balance on that day changed from 240 plus 135 is 375 until the 13th. between April 3rd, between April 3 and April 13, that was 10 days, so that's 10 times 375. So on the 13th, that person made a payment of $150. So the balance is now 375 minus 150, or 225, until April 23rd. From April 13th to April 23rd, that's 10 days. So that's 10 days with that balance. Okay, on April 23rd, this person was charged $30 for DVDs. Okay, so the balance is now 225 plus 30, that's 255 until April 28th. So from April 23rd to April 28th, that's 5 days with a balance of 255, or $1,275. On April 28th, there was a charge of $28 for groceries. The outstanding balance is 255 plus 28, or 283. For 3 more days, April 28, 29, and 30. This is 849. So if you add the balance after each day, 480 plus 35 plus 3750 plus 2,250 plus 1,275 plus 849, the total is 8,604. And the average daily balance is that over 30. April has 30 days, so that's that is $8,604 over 30 days, or $286.80. This is the average daily balance, and the finance charge is PRT, where P is the average daily balance, R is the interest rate. So in the statement, it says that the annual interest rate is 21%. And T, with the average daily balance method, T is the number of days in the month divided by 365. If April has 30 days, T is going to be 30 over 365. And the finance charge is what? It's going to be $286.80 times 21% times 30 over 365. To the nearest cent, let's calculate that. That is 286 with 80 cents at 21%, multiplied by 30 over 365. So that's one fraction of a year. And that's $4.95. So the finance charge was $4.95. In last example, we're going to compare the two methods. So that's example 6 on page 414. So that's page 414. Suppose that you begin the month of May, which has 31 days, with a credit card balance of $500. The annual interest rate is 21%. On May 11, you use your credit card to pay for a 400 car repair. And on May 29, you make a payment of $500. Calculate the finance charge that will appear on the statement for next month using the two methods that we have discussed. Okay, so let's summarize what we have. The previous month's balance was $500. The annual interest rate is 21%. The charges, there was a $400 charge. And there was a payment on May 29. And there were no returns. Okay, so let's find the charge with the unpaid balance method. With the unpaid balance method, we have first the next month's balance is what? Is the previous month's balance plus the finance charge from last month. So that's 500 at 21% for 1/12 of a year plus the charges for $400 minus a payment of $500. So this is what? So this to cancel out. And then 500.21 or multiplied by 1/12 is $8.75. So the next month balance is $408.75. And the finance charges for next month is going to be the outstanding balance at 21% for 1/12 of a year. So the finance charge is $7.15. So that's the finance charge with the unpaid balance method. And we're going to find the finance charge with the average daily balance method. Okay, with the average daily balance method, we need to make a table with the date, the transaction, the balance after that transaction, and the number of days with that balance. And the month is May. Always start with the first of the month. At the beginning of the month, the balance was 500. So there are no transactions. The balance is 500. On May 11, you use your credit card to pay for a 400 car repair. So on the 11th, you paid $400. Or sorry, you didn't pay towards the credit card. You were charged $400. And the balance is going to be now 900. So that's 500 plus 400 is 900. On May 29, you made a payment of $500. And the balance is now $400. So it was 10 days with a $500 balance. 18 days with a $900 balance. And it May has 29, it has 31 days. So there was May 29, 30, and 31. That's 3 days with a $400 balance. So add them together, and the total is 5,000 plus 16,200 plus 1,200. That's $22,400. The average daily balance is that divided by 31. So that's approximately, to the nearest cent, that's $722 with 58 cents. And the finance charge is what? Is the average daily balance multiplied by the interest rate. And if May has 31, has 31 days, it's going to be 31 over 365. So the finance charge is $12.89. And that might be another reason why banks prefer the average daily balance method, because with the unpaid balance method, the finance charge was $7.50. And for the exact same transactions, the finance charge with the average daily balance method was more than $5 above that. So one last thing, I'm just going to read the last part. So example 6 shows that the exact same charges on two different credit cards having the same annual interest rate can result in very different finance charges. If you understand the method your credit card company is using, you may be able to schedule your purchases and payments to minimize your finance charges, or not only minimize them, but avoid them. In deciding how to use credit, you must consider many other issues that we have not discussed in this section. So if you have a credit, the advice is not to have a credit card. The advice is to have a credit card, but use it wisely. And don't use your credit card to spend money that you don't have. So some credit card companies charge an annual fee. Others return part of your interest payments, like there's a 2% cashback or 3% cashback. Others have travel rewards. Others have a grace period with no interest. But if you reduce your balance to zero during this grace period, then you pay no finance charges. Also, a credit card may have a low introductory rate that changes to a much higher rate at a later time. And be careful with that, with the with the interest rate. So usually, store credit cards like Home Depot or Walmart, those store credit cards have a very high interest rate. Good credit cards are going to be credit cards from Wells Fargo, from Chase. So those are good credit cards with reasonable interest rates. One common enticement is that you can make a purchase and pay no interest payments until several months later. But if you haven't paid your balance, you need to be careful. After you do not pay off the purchase completely at the end of the interest-free period, then all the interest that would have accumulated is added to your balance. It is difficult to understand all the pros and cons of the many different types of credit card contracts. However, if you read credit card agreements carefully and remember the principles that you learned in this section, you will be an intelligent consumer who will be able to use credit wisely. So this finishes chapter 8. Thank you for listening.